Assalamu alaikum. In this video, we will discuss the use of work papers in preparing the consolidated financial statements on the date of acquisition. It will focus on balance sheet accounts. It will explain how to record the investment in the subsidiary on the parent's books at the date of acquisition. It will also explain how to prepare the consolidated work papers and eliminating entries at the date of acquisition. Finally, we will explain how to compute and allocate the difference between implied value and book value of the acquired firm's equity. But in the beginning of this session, I would like to thank my son Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories, without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement and constant support, who allowed me to use time for her in making this video. Let us start with work papers. On the date of acquisition, the most relevant statement is the consolidated balance sheet. The consolidated balance sheet reports the sum of the assets and liabilities of a parent and its subsidiaries as if they constituted a single company. Assets and liabilities are summed in their entirety, regardless of whether the parent owns 100% or a smaller controlling interest. The non-controlling interest are reflected as a component of owner's equity. Let us now talk about intercompany accounts to be eliminated. Since the parent and its subsidiaries are being treated as a single entity, eliminations must be made to cancel the effects of transactions among them. For example, intercompany receivables and payables must be eliminated to avoid double counting and to avoid giving the impression that the consolidated entity owes money to itself. Likewise, any intercompany profits in assets arising from subsequent transactions must be eliminated, since an entity cannot profit on transactions with itself. A work paper is frequently used to summarize the effects of the various additions, eliminations, and so forth. Some of the transactions that necessitate eliminating entries are given here. The process of combining the individual assets and liabilities of a parent company and its subsidiary at the date of acquisition is discussed next. While preparing the consolidated statements, the first elimination to be made is of the investment account and the related subsidiaries' stockholders' equity. Investment account represents the investment by the parent company in the subsidiary and is the reciprocal to the subsidiary company's stockholders' equity. In the consolidated balance sheet, the subsidiary assets and liabilities are combined with those of the parent company. It is therefore necessary to eliminate the investment account of the parent company against the related stockholders' equity of the subsidiary to avoid double counting. Thus, when the parent company's shares of the subsidiary company's equity is eliminated against the investment account, the subsidiary company's net assets are substituted for the investment account in the consolidated balance sheet. If the acquisition is for less than 100% of the subsidiary, the fair value of both the controlling interest and the non-controlling interest must be determined. The fair value of the controlling interest is generally assumed to equal the amount paid by the acquirer. If a company acquired less than 100% acquisition, then the non-controlling interest will be recorded on the balance sheet. The process of combining the individual assets and liabilities of a parent company and its subsidiary at the date of acquisition is discussed next. The first step in the consolidating process is to prepare a computation and allocation of difference between implied value and book value. This requires to address three basic issues. Number one, determine the percentage of stock acquired in the subsidiary. Is it a 100% acquisition or less? Use the purchase price to compute the implied value of the subsidiary. Simply divide the purchase price by the percentage acquired to calculate this value. If the percentage is 100%, the implied value will equal the purchase price. Compare the implied value from step 2 to the book value of the subsidiary's equity. Let us explain more with the help of an illustration on the next page. A company has acquired another business and they have acquired 75% and the acquisition price is 75,000. The 100% of the implied value is 100,000, that is 75,000 divided by 0.75 and that will be equal to 100,000. Suppose the book value of S is 70,000 and the difference now between implied value and book value is 30,000. This difference will be recorded as increase in land by 15,000, suppose for that reason, and suppose there is an increase in to building by 10,000. So the total allocation now is 15 plus 10, that makes 25, and the residue amount of 5,000 will be allocated to goodwill. So these steps lead to the following possible three cases explained in the next slide. Implied value is equal to the book value. Implied value exceeds book value, or implied value is less than the book value. We make two types of entries when preparing a consolidated financial statement. Actual entries that are recorded in the books of one of the two companies and work paper only entries, and these entries are never posted to the books or accounts of either company's general ledger. However, these entries will be repeated each year in the consolidating process. Let us look into the first case where acquisition is 100%. If the purchase price is exactly equal to the book value of the equity acquired, the investment account will be eliminated against the equity accounts of the subsidiary. The eliminating process will completely eliminate the investment account and equity accounts of the subsidiary since it is a 100% acquisition. The investment account is replaced with the underlying assets and liabilities of the subsidiary. To illustrate, assume that on January 1, 2021, P company acquires all the outstanding stock of S company for a cash payment of 8,000. P company would record an actual journal entry as investment in S company debit and cash credit. The computation and allocation of difference between implied value and book value schedule reveals no difference. Eliminating entry will be made to cancel the effects of intercompany transactions and is made on the work paper only. The work paper entry to eliminate S company's stockholder equity against the investment is equity debit and investment in S company is credit. Immediately after the acquisition, P company has 2000 in cash. Before acquisition it was 10,000 and 8,000 in an investment in S company account. These amounts appear in the first column of the work paper. The implied value of the subsidiary equals the purchase price. Let us look into another case where implied value is equal to the book value, but the parent company acquires less than 100%. In this case, P acquires less than 100%, so we introduce a non-controlling interest. In this situation, the purchase price of 6,400 for 80% is equal to 8,000 if we take the 100%, that is 6,400 divided by 0.8, this will give you 8,000. The non-controlling interest is thus 20% of 8,000 and that is 1,600. Now since the implied and book value are equal, the entire 100% of S company equity is eliminated 80% against the investment account, while the remaining 20% constitute the non-controlling interest. Since the purpose of the consolidated balance sheet is to report the net resources under the control of a single management, thus all S companies' assets and liabilities are combined with those of P company on the consolidated balance sheet. And the non-controlling interest representing the non-controlling shareholders' interest is shown as a separate component of stockholders' equity. A work paper entry will be equity for subsidiary is debit, investment in S company is credit, and non-controlling interest is credit. You can note that the separate column is added to the work paper. In the illustration between the elimination columns and the consolidated balances to compute the non-controlling interest in the equity. The total in this column represents the percentage of equity of S company not acquired by P company and recorded at the fair value implied by P company's acquisition price. The total non-controlling interest is transferred to the consolidated balance sheet column. In the next case, we will illustrate the situation where the purchase price is higher than the book value of equity. Why an acquiring company may pay more than the book value is explained in the next slide. The reasons may be that the fair value of specific tangible or intangible assets of the subsidiary may exceed its recorded value because of appreciation. Excess payment may indicate existence of goodwill. Liabilities, generally long-term, may be overvalued. There may be a variety of market factors that may affect the price paid. Let us look into an example when implied value of subsidiary is more than the book value. On January 1, 2021, P company acquires 80% of the outstanding common stock of S company for 9,000 cash. The purchase price 9,000 for 80% of S company implies a total value of 11,250. The implied value of non-controlling interest is 2,250, that is 20% of 11,250. The total implied value of 11,250 exceeds the book value of the equity of 8,000 by 3,250. The entire difference is attributed to land. If the difference is larger than the amount needed to adjust all net assets, then the excess is goodwill. It is possible that by adjusting all the net assets to the market value, a negative balance could result. The situation referred to as a bargain acquisition occurs when the acquisition price is less than the market value of the identifiable net assets acquired. Returning to the example again, the first workpaper investment elimination entry is equity is debit and investment in S company and non-controlling interest is credit. A new account entitled difference between implied value and book value is created in this entry. This is a temporary account that is immediately eliminated in the next entry. In the next case, we will illustrate the situation where the purchase price is lower than the book value of equity acquired. Why any acquiring company may pay less than the book value is explained in the next slide. I would like to explain a bit more on the consolidated balance sheet. If implied value is more than the book value, you can see that the cash is reduced to 1,000. Land has increased by 3,250. And the difference between implied value is more than the book value, and the difference will be distributed to adjust net assets upwards. Finally, we illustrate the less common situation where the purchase price is below the book value of the acquired equity. Let us first look in the reasons why a acquiring company may be paying less than the book value may be: one or more of the subsidiary company's assets is overvalued, one or more of the subsidiary company's liabilities is undervalued, or the parent company simply made a bargain purchase. Let us look into an example when implied value of subsidiary is less than the book value. On January 1, 2021, P company acquired 80% of the outstanding common stock of S company for 6,000 in an investment in S company. The implied value of subsidiary is thus 7,500, that is 6,000 divided by 80%. The non-controlling interest is 1,500, that is 20% of 7,500. The book value of S company, equity of 8,000, exceeds its implied value of 7,500 by 500. We assume that the difference between implied and book value is attributable to equipment. In this case, an overvaluation of 500. As usual, the computation and allocation schedule yields two eliminating or adjusting entries. The investment elimination entry is equity is debit and investment and non-controlling interest is credit. Note that the difference when the difference is negative in the journal entry, it is recorded as a credit in order to balance the entry. In the second work paper entry, the account will be debited to eliminate it, and the appropriate underlying asset or liability account will be adjusted to reflect the net downward adjustment of the net assets. The second elimination entry you can see is difference between implied value and book value is debit and equipment is credit. The consolidated balance sheet, you can see that since we have purchased it for 6,000, so the cash balance is 4,000. Equipment has decreased by 500. The difference between implied value and book value has been counterbalanced, and that's why we have a balance of 0. The non-controlling interest is recorded in the balance sheet. So this completes our discussion on use of work papers in preparing the consolidated financial statements on the date of acquisition. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any questions regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning. Thank you.